Welcome to Meridian's results announcement for the half year to 31 December 2017. I'm Neil Barclay. I replaced Mark Binns as Chief Executive on the 1st of January, and with me I have Paul Chambers, our CFO. Now I have to apologise, Paul and I are both from Christchurch and we're on audio for this presentation. With the stormy and wet conditions over the last 24 hours, our travel was fairly significantly disrupted, and I guess there's a bit of an irony in that because we'll be talking to a result that has been impacted by drought quite significantly. Moving to some opening comments, the prevailing influence on our interim earnings, as I just sort of alluded to, has been dry South Island conditions. We've really only had a couple of months of good inflows into our catchments in the last 12, and that's resulted in our generation being around 1,100 gigawatt hours, or 16% down on last year. It's also our lowest first half generation since 2008. Accordingly, the interim results is the first to show an earnings decline since December 2012 half year. Now at this point I could say that's all Mark Binns' fault, but I won't because he might be listening, and also because it's not quite true. The reality is, as a hydro operator, we know we can expect these conditions from time to time, and we do plan for them. We're actually quite pleased with how the business has performed during this period. I think it showed up the strength of our business model, and particularly how our risk management practices have stood up to the challenge. In particular, it was very pleasing that we were able to keep up positive momentum in acquiring new customers through the period. We'll talk to that more as we get into the guts of this presentation. We've been very active in the Australian wholesale markets over the last few months. We've procured the Green State hydro assets, and we've signed 3 10-year power purchase agreements on the back of new grid-scale renewable developments. All up, this provides us with around 750 gigawatt hours of new renewable energy to support our Australian retail growth strategy. PowerShop is recognised in Australia as the most sustainable energy brand, and we believe with our unique customer offering there's plenty of growth potential for us in that market. We've done a lot of work during the period assessing the feasibility of consolidating our current customer platform architecture. We've developed the PowerShop billing and customer care platform in-house, and the opportunity is to leverage that investment to also support the Meridian branded customer base. We'll do this if it will reduce cost, improve the customer experience, and improve our agility in a fast-moving market. Our board is considering this opportunity in April, and if we proceed, it will involve reasonable timeframes. And that's so as to avoid any chance of negative customer experiences and to allow for a seamless transition. I think we'd be talking about at least a 2-year transition period. There's been a lot of commentary recently on the government's target of 100% renewable generation by 2035. From our perspective, we applaud the government for setting this ambitious goal, and we also believe it's a realistic goal. I think we're exceptionally fortunate in this country to have such a strong base of highly efficient and flexible hydro generation that can accommodate a lot more intermittent renewable generation like wind and solar without causing system stability issues. But we also have limited hydro storage, so the real challenge is finding the right mix of alternate fuel storage and demand response capability to allow for the odd protracted drought. Now, we're confident that this challenge is solvable with the right market incentives in place. We also think that with such a strong renewable generation base already, the environmental opportunity in the electricity sector is far greater in the context of the decarbonisation in New Zealand's economy, including the transition of large-scale industrial heat processes and the transport sector to electric. It just makes sense for our country to aggressively pursue these opportunities, I think. And lastly, we've made some changes to the Meridian exec team. There's obviously myself. We've managed to recruit Julian Smith to replace me as GM of our New Zealand customer businesses. Julian has strong digital marketing and leadership experience from a variety of sectors, including retail, banking and technology. He joins us early next month, and I'm really excited to get him on board. I've also split the General Manager Markets and Production role into 2, the first being Generation and Natural Resources under Guy Waipara, and the second being Wholesale under Mike Roan. And this change was to allow a greater degree of focus on the consenting renewable development space and to lift the development of our wholesale strategy to exec level. And I guess that becomes critically important as wholesale strategy is the key to allowing customer growth. So if we move to the financials, the high-level snapshot, here they are. As I said, the story for the 6 months has been low inflows, low generation, and so New Zealand energy margin was 7% down. This was offset partially by an improvement in Australian energy margin of 19%, and all up, EBITDAF at $329 million was down 7% on the prior period. That flows proportionally through to NPAT and operating cash flow. The positive is that given the hydro generation was down by 16%, the business still produced a reasonable result, and it's also given us the opportunity to show the strength of the balance sheet by declaring an interim dividend, which is 1% up on last year. Meridian has the strongest balance sheet in the sector. We've structured it that way to allow the business to ride through multiple droughts and a potential exit of the New Zealand aluminium smelter at Bluff, and still maintain a progressive dividend policy. Now, for the record, I'm not expecting the aluminium smelter to close anytime soon, but we continue to maintain the balance sheet capacity to absorb the short-term cash flow hit if that were to happen. Looking at demand, parts of the country have endured very dry conditions, which has boosted irrigation load up compared to a wet year in 2016. And this was a large contributor to the 1.2% of demand growth that we observed during the period. But it's also encouraging to see demand growth across all urban areas of New Zealand, especially given the warm weather during November and December. Our in-house view is that we can expect to see modest demand growth, somewhere between 0.5% and 1% sustainably over the medium term, and I think that's consistent with what we've seen this half. Now, clearly, South Island hydro inflows and storage have been low, but the North Island storage you'll see from the graph has experienced inflows at a regular rate, which has helped maintain a reasonably stable market. The good news is that during the Waitangi Day week, most of the South Island hydro catchments took a direct hit from ex-cyclone Whihi. This was the single biggest inflow event into the Waitaki catchment since 2013. And to give you an idea of the scale, Lake Pukaki lifted by around 2 metres during that event. Also, with the rainfall last weekend, what's occurring right now, and we've got a good forecast for the current weekend, we're getting back very close to average for this time of year. Looking forward, we expect the weak La Nina conditions that emerged in late 2017 are likely to neutralise by March, so more normal than dry conditions from here, we think, although it's fair to say normal is an elusive thing. I guess the key thing in all of this is that the wholesale market has responded as expected. We've seen higher wholesale price signals in the short end of the forward price curve, greater thermal utilisation as a result, and no security of supply concerns. The longer-term forward curve remained reasonably stable because it shouldn't be, and it isn't necessarily influenced by short-term hydro volatility. And I guess these are all signs of a well-functioning and efficient wholesale market. Which is a good segue into some comments regarding the government's proposed electricity price review. Meridian made a submission to the draft terms of reference to that review. In summary, it is our view that the competitive parts of the New Zealand market are operating very well. New Zealand has the 11th lowest residential power price out of 32 OECD countries. The energy component of residential power prices has gone backwards in the last 3 years and certainly hasn't gone forward over the last 7 or 8. And I can tell you that Meridian won't be increasing its energy price in the latest round of lines company costs because, frankly, competitive pressures won't allow it. And security of supply hasn't been a threat for over a decade, despite at least one record-setting drought during that time. I mean, there's other data points you can look to, and what we're really saying is just don't be tempted to throw the baby out with the bathwater on this one. The best bang for buck, we think, will come if the review focuses on the key opportunities that have already been identified, and there's quite a degree of industry consensus around. And in our view, these are, 1, the review should focus on ensuring that the regulatory framework is future-proof to accommodate the new opportunities for customers that are emerging from new technologies and new retail business models. 2, I don't think you'll find anyone in this industry who believes that the low user fixed charge regime is hitting the mark and not, in fact, creating perverse outcomes, so that needs to be sorted. And 3, distribution pricing needs to become far more cost reflective to avoid unfair and efficient outcomes going forward, particularly driven by the penetration of new technologies. Now, the Electricity Authority has been favouring a market-led approach to resolve these issues, but it's fair to say progress has been slow. We understand the pricing review will be conducted by a panel with an independent chair. MB will be the secretariat, and we should see the final terms of reference within the next month. And obviously this will be a key focus for many of us in the industry over the next year. Now, by contrast to New Zealand, Australia does have some significant challenges, and they have led to some pretty poor outcomes for consumers over the last couple of years in the form of large price increases and significant outages. As a result, the regulatory environment is highly politicised at both the state and federal level, and they're not always aligned. I guess they won't be until some form of bipartisan support for some form of clean energy target is achieved. Now, all that said, we still think Australia offers a great opportunity for renewable development and retail growth, but I can assure you we go into it with our eyes wide open. And we have a very capable team in Melbourne under Ed McManus who are very closely managing our risks. Really, really good news on the customer front. I guess we've seen strong growth in both Powershop and Meridian. The brands have both grown strongly during the period. Customer numbers were up 3%, and the overall volume of gigawatts sold was up 12% on the comparable period. Now, if you normalise between irrigation seasons, it's probably closer to about 8%, but a positive number. There was a small reduction in the average price per megawatt due to mainly to a greater weighting in the customer mix to the business sectors. But I think overall, given the strength of the competitive pressure in the retail markets, we've got to be happy with these results. We see further opportunity for good customer growth, and in particular we're focusing on the commercial solar space, where we're working closely with Kiwi Properties and other large customers to deploy solar at scale. And we're also continuing to strongly support the take-up of electric vehicles. We've had market-leading EV rates in the main centres for some time now, and today we're launching our new nationwide EV tariffs that offer customers a 20% discount and free charging of their EV for a year. It's pretty compelling. Also, we're committed to the cause, and at least 50% of Meridian's own passenger fleet will be fully electric by June this year. Now, whilst we were able to grow volume and customer numbers, this is not yet fed through to margin due to the mix of business across the period, and we did invest in promotions and acquisition costs to build some momentum in our customer growth. We expect to see margin improvement as we move forward. Churn rates across the industry remain quite high, which again is due to being engaged in a highly competitive market and low barriers to switch. Meridian remains slightly below the industry average for churn. Powershop's churn, because they tend to serve a younger demographic with a higher proportion of rental properties, remains higher than average, but we're seeing signs of improvement there. Clearly, continuing to focus on building customer loyalty must remain a focus for us. Wholesale. Now, I've talked about the key issues in wholesale already. The extent of the dry sequences is pretty evident, and when you look at the top graph, which shows inflows into Meridian's Waiau and Waitaki catchments. Consequently, and in particular for the first 2 months of this half year, but also leaning into the back end of the half year, we were very conservative with our hydro storage, and as a result, generation was down by 16% on the prior period. We also acquired significantly more generation from the market to cover our contracted sales. Obviously, hydro risk mitigation measures that were able to be deployed, like the swaption with Genesis, along with the smart use of the water that we did get, ensured we protected the business against further earnings downside. Now, we've also added a graph on snowmelt because there seems to be a fascination with it. As you can see, we've seen a 30-year high snowmelt. In climate science timeframes, 30 years doesn't really count as a trend, so we need to be careful reading too much into the outcome for this year. That said, all the predictive science we're seeing suggests that rising snow lines will be a trend, and also the experts reckon we can expect overall wetter conditions in the main West South Island hydro catchments. So it's a reasonably positive outlook for the future, we think. Now, I'll hand over to Paul Chambers at this point. Paul's the director on both our Australian and Flux subsidiaries, and he'll talk to the results of those two businesses.
Thanks, Neil. We've seen good progress in Australia this year with 20% growth in retail volumes over the same period last year, and you can see that in the numbers. We've also seen, with the continued roll-off of some older hedges at lower market prices for our wholesale position, a greater exposure to the higher recent market pricing, and that's had its own positive impact. So those two together have really driven the margin increase. We have been deliberately cautious in growing customer numbers across the half, given the sharp rise in wholesale prices we saw at the back end of FY17 and the consequent increase in the cost of hedging our retail business. But we think our proposition and brand can support a bigger customer base. So taking a longer-term view to support that growth is important, and the acquisition of 92 megawatts of hydro assets and signing of 3 PPAs that support the construction of new renewables represent the key steps for future retail growth. In the UK, we continue to hit all our delivery milestones and all within planned costs. npower now have the essential tool of a dual fuel offer. In a country where more than 80% of customers are dual fuel, full noise launch had to wait until this moment, and progress now really depends on the sales and marketing decisions that our customer makes. Moving on to something which has been a bit of a topic of conversation by analysts recently, which is where transmission pricing is going, and this is outside TPM. Mainly due to the closeout of historic recoveries for underpayments by Transpower, we're due to see quite a big fall in HVDC charges in 2021. Now, obviously, this is under the current regime, and we've been pretty clear we don't count any chickens on timing of the TPM review, so this is actually looking like a likely outcome. It is all good news, but it doesn't factor in, of course, any further enhancements to the link, so an additional cable or strengthening of either of the repeater stations, though one would hope that by then those costs will be equitably borne by all the parties that benefit from them. Moving on to the detailed financials and starting with dividends. As Neil has already mentioned, our strong balance sheet means that we can continue to progress ordinary dividend payments and continue the capital management program under poor hydrology scenarios. This does mean that our payout ratio has risen close to the top of our preset band, and you should expect that ratio to drop back again under more normal hydrology. The ordinary dividend has been imputed to 88%, and that's consistent with prior periods. I think the question which is going to be asked is, with the capital management program now just over halfway through, and we paid out 375 million to date, the question is going to be from most people, well, what next? And we are working on this, and we are still planning to do exactly what we said we'd do and come back to investors with a view towards the back end of this calendar year. Moving to a top-down earnings view, it's pretty easy to get lost in the ups and downs involved in the movement in EBITDAF. So I'm going to talk a bit about those things that had a material impact on earnings, both those specific to Meridian and those driven by the NZ market and, of course, the weather. It's been great to see strong retail growth in such a competitive environment, as Neil said, although that didn't translate into immediate margin growth given 3 main factors. First, the lag effect of acquisitions. Obviously, you don't get the volume until you've got the customer, and a lot of those customers came in towards the back of the 6-month period, plus the large amount of irrigation that we saw, which skews the agri-sector pricing, and finally, the inclusion in the numbers of one very large short-term deal in the C&I segment, priced at levels that turned out to be no better than short-term ASX prices. That deal is then now at an end. We have seen some operating cost expansion to support growth, as Neil said, and reflecting large asset projects which had a smaller proportion of capital spend than previous projects we've been going through recently, and we've talked about those before. Those costs were partly offset by reduced transmission costs and then fully offset, in fact, by reduction in capital stay-in-business CapEx. Adding to the positive long-term impacts of retail growth, we obviously had the impact of the TY price increase and back-to-back deals that kicked in from the 1st of January 17, and obviously, therefore, we're not in the comparative period last year. And, of course, the net positive impact of our overseas operations was extremely helpful. But despite the positive overall impact of factors directly within our control, the weather gods proved the strongest force of influence, and whichever way you look at it, a gap of 1,100 gigawatt hours against last year is hard to counter. And just to give you a feel, if we sold that energy at half current long-term ASX prices, you get somewhere around $40 million. So that's not a completely clean analogy given all the moving parts, but it is something that puts a bit of context around a $25 million shortfall. This next slide gives you a bit more detail on cost. Now, we've talked to most of that already. So overall, if you look at things from a cash perspective, a net $5 million operating cost increase was fully offset by lower transmission costs and lower stay-in-business capex. And look, we are committed to maintaining discipline on cost. In a world where our customer expectations are inexorably rising and competition is squeezing prices, we have no choice. Just a minute on the boring accounting bit below EBITDAF. Nothing too surprising here, except maybe the relative stability and non-cash fair value movements on financial instruments. I think once in a while, technical accounting makes sense, although you're not to tell anyone that, or a whole load of accountants might be out of a job. I'll just hand back now to Neil for some closing comments, and then we'll move to questions.
Thanks, Paul. I've just got a couple of concluding comments. Whilst we have experienced some challenging hydro conditions over the last calendar year, the inherent strength of the Meridian business and balance sheet is clearly shown up, and we've been able to continue to deliver good dividend outcomes for shareholders. That's really the key message here. And we've also had some really solid success in growing our customer base over recent months. We're certainly not taking any of that for granted. There's still a lot more we can and we will do to ensure we stay focused on managing our costs and delivering great value and innovative solutions for our customers. So I think with that, we can hand it over to questions. And we'll probably take questions from the floor in Wellington first, and then we'll go to the phone lines.
No floor. No floor.
Sorry? Oh, we've got no floor in Wellington. Sorry, we weren't aware of that. So we'll go straight to the phone lines.
Thank you, sir. Ladies and gentlemen, if you wish to queue for a question, please press 0 followed by 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press 0 then 2. Once again, that is 0 followed by 1 on your telephone and wait for your name to be announced. Your first question is from the line of Grant Swanepoel from Craig's Investment Partners. Your line is open. Please ask your question.
Morning, team. First question is for Paul, just on PowerShop. When are you expecting to get your gas contracts in place so you can release the growth in Australia again? Second, also on PowerShop, in terms of how the progress is going on the IT in the local market and what sort of cost could drop to the bottom line if you do go ahead on that front. Third one is, question is for Neil, if possible, and that is around your comments that you don't intend raising prices in the near term. Are you going to leave Genesis hanging out there with their 2 to 4% price increase that they put through in January? And then final question, you talk about the carbon-free world potential. Are you guys in conversation with Fonterra on any of their drying plants at the moment? Thanks.
Okay, take the first one first. On PowerShop Australia and gas. Yeah, that's in sight now, and we are expecting to be able to get into market before the end of the half. So, the hedging strategy is already established. It's all doable. That's the first one, but it will be a slow start, obviously family and friends and all that sort of stuff. The second question about the local market, I don't think we're in a position to sort of describe what that might do in terms of bottom line impact. Obviously, we're not going to do it unless it's positive. And that's going to be not just about operating costs, it's also going to be about capital costs and forward capital costs, where that might go. It's something that we will be talking about later down the track if we go ahead, but we're not in a position to give you numbers at this stage.
Grant, I can pick up the other two parts of the question. First of all, can I just acknowledge it's really great to have you there. We know that Fletcher Building were announcing at 11 o'clock this morning, so we weren't quite sure what sort of audience we might get. But on the price increase issue, look, I'm not going to comment on what any of our competitors are doing in the market. All I can tell you is what we're doing and what we're aiming to achieve, and we think competitive pressures are such that it wouldn't be appropriate to pass on energy costs at the moment, or any increase in energy costs at the moment. And on the Fonterra issue. I mean, we've had some informal chats over time with Fonterra, but I guess they'll be engaging parties in a more formal process over time, but that would be very much driven by themselves. But we'd love to be engaged in a conversation around some of the opportunities around that drying plant, that's for sure.
They are getting moving now, Grant, so it is looking like that they're taking the issue seriously, and we will see some movement.
Thanks.
Thank you. Your next question comes from the line of Andrew Harvey-Green from Forsyth Barr. Your line is open. Please ask your question.
Morning, guys. A couple of questions from me. First one, I guess, just around the retail side of things. And are you comfortable with the pricing of the agri load, just given, I guess, what's happened in the first half and the increase in demand there?
Andrew, it's Neil here. I believe we're comfortable. I mean, we play a long game on this. I mean, in irrigation, volumes can lift and they can be down, but we're trying to make sure that we're competitive in the context of the market over a reasonable time frame, because the relationships we have with customers, particularly in that sector, and hopefully in most sectors, but particularly in that sector, is very much built on strong relationships and mutual respect. So we look after them and they look after us over time.
I guess the bit I sort of forgot to mention was just given the dry conditions as well and the high wholesale prices and the correlation you've probably got there with high wholesale prices and strong agri load.
Yep, but you can easily get the opposite, where you have very wet conditions, low prices, and that quite often doesn't match. The hydro catchments don't quite often line up in terms of the conditions with where the irrigation's going down. So we're still playing a long-term strategy there.
Andrew, you have to look at the sort of multi-year average of where your position is and be satisfied with that. And then the question is, can you manage your risk position in and amongst that? Yeah.
So in essence, what I'm sort of really hearing is that you're saying it's not quite as correlated as we probably, or what we've seen, I guess, in the last 6 months.
That'd be correct, yeah. In fact, the long-term patterns are not that correlated.
I mean, we've had recent years where there's been very dry conditions on the East Coast, and we've had very good inflows into our catchments and made, and that was a very strong position to be in.
Next question, I guess, is just on the retail growth and the main, factors behind you pushing that growth. Has it really been about discounting up front, or what have been the incentives you've been putting in place to customers to actually get them to move across?
I think it's been it's a multi-pronged effort across all aspects of the retail business, Andrew. There's no one. We certainly haven't been discounting more heavily than anyone else in the market. We've got upfront incentives like everybody else, but we do have a strong service proposition. We've also got really tuned in and successful sales channels that have been doing particularly effectively in terms of acquiring that customer base.
It's about just optimising hundreds of things, Andrew. And there's been a degree of professionalism exhibited through both retail brands in a whole array of places, and that's where you get your movement. You get the movement in the acquisitions coming through the door and retention at the back end.
Yeah. Okay. And I guess sort of linked to that is the new EV strategy. You're thinking about how to keep those customers after the 12-month period. Clearly, there'll be attractive customers to hold on to, given the load of the EV customers will bring.
Yeah, I mean the product is launched as of today. It will be modified and changed over time, and then nothing's going to be absolutely stagnant. And I wouldn't like to say what it'll look like in a year's time. I will say though, on today's terms, with the discount that we're adding into that product for EV owners, it's still pretty attractive. So we'd back ourselves to retain customers in the current market, but who knows what it's going to look like in 12 months' time.
And but
I think you're pointing to the right thing, that retention of those customers will be key, and we won't take them for granted.
Yeah. It's worth remembering also from our perspective that it's a positive overall thing for more EVs to be in the market. So for people to be putting attractive offers, infrastructure to be being built, all of that sort of stuff, we'll sort of put our back to the wheel on that, because the more EVs, the better from our perspective.
Yeah. Okay. At the beginning of the call, you sort of talked about or alluded to, I guess, the 2035 100% renewable, and as well as, I guess, we've had the Genesis coal announcement. And you talked about or alluded to sort of the right market incentives. Are you able to give us some colour on sort of what you see as being the right market incentives?
Probably a few things. I think ensuring that we maintain a market where we get a really strong energy signal is still important. I mean, there's a lot of talk about capacity markets and the like. We see a good example of capacity payments in the form of the insurance we pay with the Genesis swaption today. So I think still market-driven signals as opposed to regulatory-driven structures is probably the right way to go. And I think fundamentally you're also going to have to see a realistic view of carbon factored into the economy at some point in terms of the genuine cost of that to the environment.
Okay, and the last question from me, because I've sort of realised I've asked quite a few, but the impact of the Genesis Tekapo outage on earnings from Meridian, and is that going to have much of an impact for you?
Well, we're watching it closely, Andrew. I understood, I think, breaking news that Genesis have just signalled that outage is going to go out from April to June or July. I don't have the exact details on that. So that is a concern, because at the moment Lake Tekapo is full, and because they can't pass enough water through the Tekapo B power station, some of the water is now being spilled down to Lake Benmore. That's not an ideal outcome. It will really depend on how full Tekapo stays and for how long. And then again, how quickly they can get Tekapo B back into service. We're not seeing it as a massive financial risk at the moment, but it's something that we stay close to, and it will very much depend on what happens hydrology-wise from here.
You can do the maths yourself, Andrew. You know which stations are being bypassed. You know how many cubics are being spilled. So it's just a crying shame seeing all that money disappear.
Yep. Okay, that's all for me. Thanks.
Thanks, Andrew.
Thank you. Your next question comes from the line of Peter Wakeman. Your line is open. Please ask your question.
I've got a few questions. The first one is your insurance activated by the potential loss of that Lake Tekapo? Genesis?
No, it's not. No, it's not, because it's an outage for a mechanical repair, Peter. So if the Tekapo stations were hit by a natural event, an insurable event, if you like, then we would be insured. But insuring against mechanical failure even is difficult. Insuring against planned outage is virtually impossible.
So Genesis, in some ways, has a lot less, an awful lot less to lose than you. Do you think they have got all the incentives to try and get it fixed in a timely manner?
We've got absolutely no indication whatsoever that they don't, and you'd have to put a question to them about that. But I from what I understand, and we're talking closely with their engineering people, they're working very hard on getting the situation sorted.
So do you think that timescale could come back, or do you think they've been sort of putting it out there as a worst scenario case?
Look, you'd have to ask them, Peter.
Yeah, I thought you would already know that. Going to Australia, when you look at the arrangements that you've made, do you think that the funding of those solar acquisitions, the power you're doing, they have an advantage when they can borrow money at a lot lower rate than what New Zealand or Australia has an offer? For example, the US and will have less interest rates, and in Europe and other places, some can have negative interest rates. So do you think the financial ability of people to raise money at low cost sort of decides who builds and who doesn't build infrastructure?
Well, we're not obviously funding these except by way of the PPAs, Peter, but clearly funding costs are critical to the end outcomes there, plus views of what the future world looks like by those developers. But you've seen relatively cheap money available globally. It looks like that's starting to come to the end of its runway. I wouldn't say that gives sort of Australia some sort of natural advantage, remembering that energy is only going to ever service Australia. It's part of the equation.
And do you have options at the end of the contract to acquire them, or what sort of protection do you have if the contract doesn't get renewed after 10 years?
They are not contracts which we are going to talk about the commercial terms of, but they're not sort of natural acquisitions. They are straightforward supply agreements. And we have confidence that the Australian market is going to be sufficiently liquid to allow us at the back end of that period to cover our position. Australia is a mature market. It's got 5 times the consumer base, just the NEM, than New Zealand. And despite government intervention and the problems that that's caused, we believe the market will respond.
And with regard to the New Zealand market, do you think it's wise getting new customers with that thing of Genesis, with the potential rise of cost of the wholesale prices?
What thing of Genesis are you referring to?
Well,
with the
water,
the outage.
Lake Tekapo.
Look, I think Meridian can manage our position through winter. We're very confident of that, and we're confident we can do it with additional customers.
In terms of wholesale price, the Tekapo outage would be in the noise.
Mm.
So the Genesis, with regard to that, they're not obliged to supply you any thermal generation?
No. There's no specific requirement for that. I mean, we do have a option which is known about, and we called on that from time to time, but we're certainly not calling it at the moment, and we're not envisioning doing it anytime soon. Thanks, Peter. We might have to move on to make sure we give others a chance to ask a question.
Thank you. Your next question comes from the line of Felicity Wolf from Energy News. Please go ahead. Thank you.
Hi, Paul and Neil. I've just got 3 questions, really. The first is around that demand growth. There seems to be quite healthy demand growth in some of the urban areas you've indicated in the report, particularly in Christchurch and perhaps also in Auckland. I was just wondering if I could get your idea of what might be behind that.
Bit of 2 things. One, population increases, which in the end have to feed through, even with the sort of increasing efficiency of households. And then temperature profiles across the period were more sort of where we'd like to see them. So it was warm weather at the right time, people running aircon. It's fundamentally driven by that in the sort of residential segment, and then we've seen business growth, which still seems to be GDP linked, even if it is in a sort of loose way.
Right. Okay, and you were talking before, Neil, that sort of in that 100% target that the government set. Obviously, there will have to be a lot more storage solutions found, but you also mentioned demand response. I was just wondering if, sort of in the medium to longer term, that's a market that may become or enter into the retail space.
Oh, absolutely, Felicity, and it'll be enabled by new technologies that are coming along. Some of them we can see right now, and it'll be fascinating to see what it looks like in 8 years' time. But certainly we're assuming that the rate of technological change won't slow down, and will give customers or consumers of electricity the capacity to manage their usage more effectively in line with the overall, the grid stability and capability. I mean, EVs will be part of that. You'll get EVs putting back into the grid. There's all sorts of opportunities that are developing.
Yep. Great. And finally, I was just going to check up on sort of the effects of GETA. They're probably ongoing down there, although it has found up in Wellington today. But, I think you noted that Cyclone Feihi had quite a significant effect on inflows. Is GETA looking to be about the same for your catchments?
No, GETA wasn't a direct hit into our catchments. We're still getting some water. I noticed the lift in Lake Pukaki of about 20 centimetres overnight, so that usually translates into probably that again, or half as, or maybe even twice as much. So you might get, 600 to 800 mils out of that over the next 24, 48 hours. But it wasn't the same sort of event as Feihi. But, it all adds up. And we've got another nor'wester system coming in this weekend that we think it's a bit more reliable, to be frank, than the tropical cyclones. So that's looking promising.
Yes. Cool.
Thanks.
So, yes, that should tip you back up over average.
Certainly will be in the realms of average.
We're already
normal operating procedures from us.
We're already there in the YO catchments.
Yep. Okay, thank you.
Thank you. Your next question comes from the line of Neville Glad from First NZ Capital. Please go ahead.
Morning, Neil and Paul. A number of questions from me. First one on the prices, retail prices. Now, you sort of experienced a $4.4 megawatt hour decline. In the text, you talk about the agri growth and the one-off commercial contract. I'm just wondering how much of that $4 relates to those, and therefore we should normalise that when we're looking ahead. That's one question. Another one is whether or not we should expect any kind of snow melt impact in the FY19 year. Obviously, it's low now. Just how much of that forecast impacts next year, or whether it just stays low for the permanent snow level. And maybe give a bit of colour about the Aussie merchant position. So you've got currently, retail load of about 600 to 700 gigawatt hours, but you will have by mid-2019 sort of 1,300 gigawatt hours per annum, which looks like quite long. Energy, presumably buying quite attractive prices for these new contracts. So is there a bit of margin there, and what's the track of growth of power shop load, do you think?
Which bits of you?
Should I talk to I think you can normalise to a certain extent for the large industrial contract that had an impact on prices. We'd expect to see typical pricing, average pricing for most of those segments rolling through into the future based on what we've been acquiring of late, Neville.
I think if you look at the two bits there, Neville, the Res SMB differential there is entirely agri-related, and the corporate is about half of it on this contract. I think if you looked at slide 11, we were seeing a period of some sort of sustained downward pressure on C&I pricing, but that people seem to have developed a bit of rationality in the last few months.
On snow melt, I might have to come back to you on that one. I mean, it'll depend on how cold the winter is and how much snow gets redeposited back up into the mountains, effectively. But certainly for now, the snow's all gone, and it'll really depend on the winter conditions as to how much snow melt we get back into this year.
And then the last one?
The last one was the Aussie merchant position and 2/19/20.
Yeah, this one is just somewhat tricky, given that those, the thing you'd like would be for me to give you exactly the prices at which those PPAs were signed and each volume and the profile of generation, and that's where I'd love to be with you. But all of the developers in Australia shroud everything in layers and layers of secrecy. So the thing to think about there is we wouldn't have signed those if we didn't think that they were attractive compared to market. And you can look at some of the recent market counterfactuals where there has been publicity on pricing, and imagine that we are in the realm of the low end of those. What speed we can actually build our load at, I don't really want to put a hostage to fortune out there. It really depends on where we want to go in terms of pricing and margin, and to what degree we want to pass on advantages that we obtained out of those prices we've seen in the PPAs to build a customer base. So the choice is sort of still in our hands, and I think we will sort of step our way through it. The first thing for us, though, is getting a gas product out to market, and making sure that we've got a full service offer, which is required in Victoria. That was all a bit vague, I know, Neville, but
yeah. But it's right to think that if you didn't grow your sales now in PowerShop, you would be quite long in generation over in Australia.
Yeah.
We can presume quite attractive prices.
Yeah, but our intention is to grow because our intention is to build a strategic position that has long-term benefit to shareholder value.
Great, thank you. And maybe just one follow-on question. The water agreement for Tekapo, the Tekapo assets, does anything under there triggered by the Tekapo B outage?
No, minimum flows are comfortably being met, and then obviously we look at flood management conditions or clauses in terms of how we manage that, but that's just operational, and the teams work very closely on that. So nothing commercial, really, Neville.
Great, thank you.
Thank you very much. There are no further questions from this point, sir. Please continue.
Right, well, with that, I think we can call it a wrap. Thank you all for listening, and have a good day. Thank you. Bye.